In this one, we're taking a look at flag and pennant patterns. Now, flag and pennant patterns are very similar. They will have, there's two versions of each. They will have a run higher, and then there will be consolidation of one sort or another. And as I'm sure you can imagine, that's what makes the difference. So, in a flag, you'll see a small pullback in a bit of a channel. And in a pennant, you see more of a triangle after a move higher in a bullish version. Now, there's also the bearish version, which is the exact opposite. Basically, you're looking at a run lower and then a slight pullback in a channel, or a run lower and a triangle. The beauty of these patterns is that everybody in the world pays attention to them, basically, and they're obvious a lot of times. They also come with a built-in measuring stick, so what you'll see is, with a pattern like this, a lot of times people will enter on a break of the flag, and you measure from the run up to the top of the flag. If that's $10, well, you're aiming for $10. Your stop loss, of course, is on the other side of the pattern. If that gets broken, then it invalidates everything. In the pennant, let's just say it's $8 on a break higher. You're looking for 8. Now, of course, it works in the same way, but lower. $5 pull, if you will, of the flag. You break down. You're looking to match the length of the pole. $6 pull on the pennant. You're looking for $6. It's pretty straightforward, and they're very obvious, and that's why people like them. You just put your stop loss behind the consolidation pattern, and you let it rip. So with that in mind, let's take a look at a few examples I have marked up on the charts. This is Hyatt, and this is a bullish pennant because you can see that we clearly had a downtrend line and an uptrend line after a run higher. This pull, if you will, is from 38 to 43. So it was anticipated to be a $5 run on the breakout. So we're looking at about 47 and a quarter. And you can see that we did, in fact, hit it. Took a while to get there, but we did, in fact, hit it. And in fact, most people would have been happy taking profit at the sign of trouble there at a shooting star. So you may have missed it by a quarter, but essentially the same thing. Nice gap higher. Over here in Zillow, we have a bearish pennant. You can see it was hit 3 times there, 3 times there. Kind of poorly drawn on my part, but it is there. You can see that the pull was roughly a $7 pull, so you're looking at $48. You hit that rather quick, right about here, only about 4 or 5 days after the fact. Philip Morris formed a bullish flag here. You can see we ran higher, and then we consolidated, slightly pulling back. So you're looking for the height of the flag. 87 to 92, so it's $5. We break out during this day. $5 above 92.5 is 97.5, and you can see that we get there. And of course, continue to go higher. And here in Google, we get a bearish flag. Nice run lower, and then we just kind of consolidate in this channel for a while. We gap lower, and if you had this pattern already marked out on your chart, you would have known what to expect on the move to the downside. You just take this, extrapolate it. You can see that we did eventually hit the target of about 247.5 after this huge move that, of course, did take a couple of months, but it was such a large move that it certainly was extraordinarily profitable. And again, like wedges and triangles, these are patterns that show up on all time frames, and they're very popular. So you will find that they have an extraordinarily effective rate of return on them.